We're in stage 5. That's not opinion, that's pattern recognition. And if history repeats, and it always does, you have 18 months from right now until the bottom. 18 months from stage 5 to complete collapse. That's how long it took in 1929. From the moment the smart money saw the crack to the moment the Dow lost 89% of its value, 18 months. And we can map every single month because the pattern never changes. September 1929, stage 5 began. The market was at all-time highs. Everyone believed it would last forever. Insiders were quietly selling. Margin debt had reached 8% of GDP. Valuations had detached completely from earnings. The mathematics guaranteed what came next. October 1929, the crack. The first liquidation wave. November through December, false hope and dead cat bounces. January through June 1930, the slow grind down. July through December 1930, accelerating collapse. January through March 1931, capitulation. By March 1931, 18 months after stage 5 began, the Dow had fallen from 381 to 160, a 58% decline. But that wasn't the bottom. The bottom came 2 years later at 41, an 89% total loss. But the 18-month mark is when most of the damage happens, when fortunes are destroyed, when the middle class gets wiped out. Right now in November 2025, we're at the same stage 5 moment September 1929 was. The indicators are identical. Insider selling at record levels. Margin debt approaching 8% of GDP. Warren Buffett sitting on $325 billion in cash. Valuations that make no fundamental sense. The smart money has exited, and that means we're starting the same 18-month countdown. If the pattern holds, and the pattern always holds, we're looking at May 2027 as the 18-month mark, the moment when most wealth will have transferred from those forced to sell to those positioned to buy. I'm going to show you exactly what happened month by month from September 1929 to March 1931. Then I'm going to overlay that timeline on 2025 to 2027. Show you what to watch for each month. When the selling accelerates, when the false hope appears, when the real capitulation hits, and most importantly, when you need to act if you're going to survive this, because the crash isn't one day. It's not Black Tuesday and then it's over. It's 18 months of systematic wealth destruction, and right now, the clock just started. September 3rd, 1929, the Dow Jones Industrial Average closes at 381.17. Its all-time high, a level it won't reach again for 25 years. At this moment, almost nobody sees what's coming. The newspapers are bullish. Investment advisors are telling clients to buy more. Irving Fisher, the most respected economist in America, is giving speeches about the permanently high plateau, but a few people see it. Joseph Kennedy, one of the most successful speculators of the decade, is liquidating his positions. He understands the mathematics of margin debt. When everyone owns stocks on 10% margin, a 10% decline wipes out their equity. When their equity is gone, brokers liquidate. When brokers liquidate, prices fall further. It becomes self-reinforcing, and once it starts, nothing stops it until all the leverage is purged. Bernard Baruch is also out. He's converted to cash and government bonds by September. He's seen bubbles before. 1907, earlier panics. He knows the signs, the manic conversation, the religious certainty, the dismissal of any skepticism. It's always the same before it collapses. European money is fleeing. British banks have been quietly selling American stocks since August. They've seen this before. The South Sea Bubble in 1720, railway mania in the 1840s. They know that when valuations detach from fundamentals completely, when speculation becomes universal, that's the most dangerous moment. Corporate insiders are selling in massive quantities, not diversification, systematic liquidation. Executives and directors who know their companies better than anyone are unloading 50%, 60%, 70% of their holdings because they know the stock prices don't match the reality of their businesses. They know the earnings don't justify the multiples. They're cashing out while retail investors are still buying the dream. And here's the critical detail almost nobody notices. Corporate earnings peaked in the second quarter of 1929. By September, they're declining. Factory orders are falling. Industrial production is down. Commodity prices are weakening. The real economy is already rolling over. But stock prices keep climbing, completely disconnected. This divergence is the signature of Stage 5, when prices rise purely on belief, on momentum, on the assumption that what went up will keep going up. This is where we are right now, in November 2025. The Dow and S&P at or near all-time highs. Warren Buffett with $325 billion in cash, more than he's ever held. Corporate insiders selling at levels not seen since 2007, right before the last crash. Margin debt approaching record levels as percentage of GDP. Corporate earnings showing signs of weakness. The exact same pattern, the exact same stage. September 1929 was Stage 5. November 2025 is Stage 5. And what came next in 1929 tells us exactly what comes next. Now the 18-month countdown has begun. October opens with nervousness. The market is choppy, some days up, some days down, but the volume is heavy, really heavy. Professional traders know what this means. High volume during a mature bull market usually means distribution, smart money selling to dumb money. Then, October 18th, Friday, the market drops sharply. It recovers by the close, but something feels different. Monday, October 21st, more selling. Tuesday, October 22nd, heavy volume, prices falling. Wednesday, October 23rd, panic begins. By midday, a consortium of bankers meets at J.P. Morgan. Thomas Lamont, Albert Wiggin, Charles Mitchell, the titans of finance. They announced they're forming a pool to support the market. They buy stocks. The market rallies into the close. Friday and Saturday, newspapers trumpet the rescue. The bankers saved the day. It was just a disturbance. Everything's fine. But over the weekend, thousands of margin calls arrive by mail. Monday, October 28th, massive selling. The Dow falls 13% in one day. Then Tuesday, October 29th, Black Tuesday, the most infamous day in stock market history. 16 million shares trade, the Dow falls another 12%. In 2 days, the market loses 25% of its value. But here's what's important. This isn't the crash. This is the crack. The moment when forced selling begins. The moment when leverage starts unwinding. It's not over, it's just starting. What I just showed you is the public timeline, the one everyone sees. But there's another timeline that almost nobody talks about. It's what the smart money is doing right now. The indicators they're watching, the sectors they're exiting, and the positions they're building before the next move. That's why I created the Hidden Timeline, a private series for channel members only. In these videos, I can share what I legally can't say publicly. The signals flashing before every major crash, and which sectors are about to break first. There are 2 membership levels. Insider access, just $3 a month, gives you access to the weekly Hidden Timeline updates every Monday and Thursday. But if you want the complete picture, the deep reports, the data, the buy lists, and the truth the mainstream can't show you, that's Empire Circle. Empire Circle members get everything. Exclusive monthly reports, private research, PDFs, and premium videos that reveal what's really happening behind the scenes. The kind of analysis I legally can't post publicly. The next private release drops this Thursday. It covers the real institutional positioning for the weeks ahead. Click Join, choose Empire Circle, and get access instantly. Because when the crash hits, information won't just protect you, it'll make you. November 2025 to December 2025 is when this happens. Based on the pattern, sometime in the next 30 to 60 days, we'll see the first real break. It might be triggered by a bank failure, a major company missing earnings badly, a geopolitical event. The trigger doesn't matter. What matters is the system is so leveraged, so fragile, that any shock will start the cascade. Watch for these signs. First, a sharp, single-day decline. 3% to 5%. Not unprecedented, but unusual. Then a rally the next day as institutions try to stabilize it. Then another decline, bigger, 5% to 8%. Then the big one, 10% to 15% in a single day or over 2 days. That's the crack. That's Black Thursday and Black Tuesday. And when you see it, understand this isn't the bottom. This is month 1 of 18. After the crash, something unexpected happens. The market stabilizes. From early November through December, prices bounce around but don't collapse further. The Dow is down about 30% from the peak, but it holds that level. Why? Because people believe the worst is over. The newspapers say it was a healthy correction, that the excesses have been purged, that now stocks are attractively valued. Investment advisors tell clients this is a buying opportunity. You should buy the dip. And some people do. They see stocks 30% cheaper and think they're getting a bargain. This is the dead cat bounce. And it's one of the most dangerous phases because it gives false hope. It convinces people who are sitting on losses that if they just hold on, they'll recover. It convinces people who sold that they made a mistake, that they should buy back in. But underneath the surface, the damage is spreading. Banks are taking losses, not visible yet, but real. The loans they made for stock purchases, those borrowers can't repay. The banks are absorbing those losses quietly, reducing lending to preserve capital. Businesses are starting to feel the squeeze. Credit is tighter. Orders are down. They begin laying off workers. By December, unemployment is rising. Not dramatically, but noticeably. People who lose jobs can't make their mortgage payments, can't make their car payments. More defaults, more losses for banks. The cycle is starting. But most people don't see it yet. They're focused on the stock market stabilizing. They think the crisis is contained to Wall Street. It's not. It's spreading into the real economy. And once it gets there, it feeds back into the market. And here's a detail that's absolutely critical. The people who bought the dip November and December 1929, the people who thought they were getting a bargain at 30% off, they watched their portfolios get cut in half again over the next year, then cut in half again. By the time it was over, they'd lost 80% to 90%. Buying the first dip is one of the most expensive mistakes in investing because the first dip is never the last dip in a leverage unwind. December 2025 through January 2026 will look like this. After the initial crash in November or December 2025, there will be a stabilization, maybe even a rally. The Dow might recover 10% to 15% from the lows. Financial media will say the bottom is in, that it was just a correction, that the fundamentals are strong. They'll interview CEOs who express confidence. Analysts will put out buy recommendations. Retail investors will be told this is the opportunity of a lifetime, and some will believe it. They'll buy, and they'll be wrong, because what's happening underneath is banks are tightening, credit is contracting, businesses are cutting, layoffs are beginning, the recession is starting, and recessions feed back into markets. When earnings start missing, when unemployment spikes, when the economic data turns clearly negative, the market will roll over again. This stabilization phase, this false hope, it's a trap. It's month 2 and 3 of 18. And the people who buy here thinking they're getting a bargain will watch their positions cut in half over the next year. The signal to watch for is the failed rally. When the market bounces 10% to 15%, but then stalls, can't make new highs, starts drifting lower. That's when you know the dead cat bounce is over. That's when the next leg down begins. This is where most of the wealth gets destroyed. Not in dramatic crashes, in a slow, grinding decline that exhausts everyone psychologically. January 1930. The market is down about 35% from the peak, but it doesn't feel like a crisis anymore. It feels like a bad year. People are hoping for recovery, believing that 1930 will be better. It's not. Month by month, the market grinds lower. February down another 5%. March down 3%. April, a small bounce up 2%. Then May down 7%. June down 10%. It's relentless, and the psychological toll is brutal. Every time you think it's stabilized, it drops again. Every rally fizzles. Every piece of good news is overwhelmed by bad news, and the economic data is getting worse. Unemployment, which was 3% in 1929, hits 8% by mid-1930. Factory production is down 20%. Commodity prices are collapsing. Farmers can't sell crops for enough to cover their costs. Wages are being cut. Companies that are still operating are reducing pay to avoid layoffs. And banks are starting to fail. Not the big money center banks yet, but regional banks, rural banks, small town banks. In the first 6 months of 1930, over 600 banks closed their doors. And when a bank fails, depositors lose everything. No FDIC, no insurance. Your money was there, now it's gone. This creates panic in communities. People who still have money in banks start withdrawing it. Better to have cash at home than risk losing it in a bank failure. But when everyone withdraws at once, even healthy banks fail. They don't have enough cash on hand. Most of it is lent out. By June 1930, the Dow is at 220, down 42% from the peak. And people are starting to realize this isn't a correction. This is something worse. But they still don't know how much worse. The really devastating part of this phase is the hope that keeps getting crushed. If the market just crashed in one day and stayed down, people could accept it, move on. But the slow grind, the constant false hope followed by more declines, it destroys people mentally. They hold positions that are down 30%, 40%, 50%, waiting for recovery, and it never comes. They watch their neighbors lose jobs. They see businesses in their town close. They hear about more bank failures, and still, they hold, believing it has to get better. This is months 4 through 9, January through June 2026. Based on the pattern, this is what the first half of 2026 looks like. The market grinding lower, not crashing, grinding. Every month a new low. Every rally failing. The economic news getting progressively worse. Unemployment climbing from 4% to 7% to 10%. Corporate earnings missing expectations quarter after quarter. Major companies announcing layoffs, thousands, tens of thousands at a time. Banks starting to report losses, write-downs on commercial real estate loans, on corporate debt. Some regional banks failing. You'll start hearing names, banks you've never heard of, in cities you don't know. But each failure makes people more nervous about their own bank, and the Federal Reserve will be trying to fix it. They'll cut rates. They'll restart QE. They'll do everything they did in 2008 and 2020. They'll print trillions. And it won't work. Because the problem isn't lack of liquidity. The problem is too much debt. When everyone's balance sheet is destroyed, when nobody wants to borrow because they're already over-leveraged, monetary policy is useless. You can't push on a string. By June 2026, the market will probably be down 50% to 60% from the peak. The Dow and S&P cut in half, trillions in market value gone. And most retail investors will still be holding, still hoping, still believing it will recover. They'll have watched their 401ks get cut in half, watched their net worth evaporate, watched years of savings vanish, and they'll be exhausted, psychologically broken, emotionally drained. And that's when the next phase starts, the phase that finishes them. July 1930. The market has been grinding down for 9 months. People are exhausted. And then it accelerates. July, the Dow falls 15%. August, another 12%. September, 18%. It's not a grind anymore. It's a collapse. What's happening is forced liquidation at scale. Individuals who held on hoping for recovery finally give up. They sell. Mutual funds and investment trusts that are getting redemptions have to sell to raise cash. They sell. Banks that need liquidity sell their stock holdings. Insurance companies that are facing claims sell. Everyone's selling. Nobody's buying. And when there are only sellers and no buyers, prices crater. The bid-ask spreads widen to absurd levels. You want to sell 100 shares. The bid is 20% below the last trade. You have no choice. You take it because if you don't, tomorrow it might be 30% below. By November 1930, the Dow is at 180, down 53% from the peak. But it's not done. December, another brutal sell-off. The holiday season, normally a time of optimism, is grim. Stores are empty. People aren't buying gifts. They're trying to survive. Banks are failing in larger numbers now. Over 1,000 banks failed in 1930. That's 1,000 communities where people lost their savings, where businesses lost their deposits, where the local economy shut down, where trust in the financial system evaporated. And this creates a doom loop. Bank failures lead to business failures. Business failures lead to job losses. Job losses lead to mortgage defaults. Mortgage defaults lead to more bank losses. More bank failures. It feeds on itself. January 1931, unemployment hits 15%. 1 in 6 workers has no job. Industrial production is down 30% from the peak. Steel mills are running at 30% capacity. Auto plants are closed. Construction has stopped. The economy is in freefall. Breadlines are forming in major cities. Churches and charities are overwhelmed. Homeless encampments are growing. Hoovervilles, they're called. Entire communities of people living in shacks and tents because they lost everything. The social fabric is tearing, and the market reflects the despair. February 1931. The Dow hits 160, down 58% from the peak. March 1931. It stabilizes at that level. 18 months from September 1929. This is the 18-month mark. Most of the damage is done, 58% decline. But it's not the bottom. The bottom will come in 1932 at 41, an 89% total loss. But by March 1931, the wealth transfer is largely complete. The people who were forced to sell have sold. The people with cash have been buying at discounts of 50%, 60%, 70%. The wealth that disappeared from middle-class balance sheets has appeared on the balance sheets of the wealthy who were positioned. Joseph Kennedy, who got up before the crash, has been buying aggressively since late 1930. He'll multiply his wealth several times over by the mid-1930s. Bernard Baruch, same story. The Rockefellers, the Mellons, all the old money families, they're buying, not at the top, at the bottom. This is how generational wealth is built. Not by riding bubbles up, by having cash when bubbles burst. This is what July 2026 through March 2027 looks like. The acceleration, the capitulation, the moment when everyone who is holding on hoping for recovery finally breaks, finally sells. And by selling, drives prices even lower, triggering more selling. The unemployment rate will be 12% to 15%. Corporate bankruptcies will be surging. Major companies that were icons will fail or be acquired for pennies. Sears and J.C. Penney already happened. Think bigger. Think names you can't imagine failing. They will. Banks will fail in clusters, not 1 or 2, dozens. The FDIC will be overwhelmed. They have about $130 billion in the Deposit Insurance Fund, but insured deposits are over $10 trillion. If 2% to 3% of banks fail, the fund is depleted. Some depositors will lose money even with insurance. The social and political consequences will be severe. Protests, unrest, calls for radical change, populist movements on both left and right. The political establishment will be under siege, and the stock market will reflect all of it. By March 2027, 18 months from November 2025, the Dow will probably be down 60% to 70%. The S&P will have lost 2/3 of its value. Individual stocks will be down 80%, 90%, some to zero. Trillions in wealth gone, not disappeared, transferred. From those who were forced to sell to those who were positioned to buy. From retail investors to institutional buyers. From the middle class to the wealthy. This is the pattern. This is what happened in 1929 to 1931. And it is what's about to happen in 2025 to 2027. 18 months. The countdown has started. Right now, November 2025. We're at the September 1929 moment. Let me show you why. With precision signal 1, insider selling. Corporate executives and directors are selling at record levels. In the last 6 months, insider sales have outpaced buys by 20 to 1. That's the highest ratio since 2007, right before the last crash. These are people who know their businesses, who see the real numbers before they're reported, who understand whether current valuations are justified, and they're selling systematically, large positions, not tax planning, not diversification, liquidation. Signal 2. Warren Buffett's cash. $325 billion, the largest cash position in Berkshire Hathaway's history, both in absolute terms and as a percentage of assets. Over 25% of Berkshire's total value is now in cash, in short-term treasuries. He's not deploying it. He sold $100 billion worth of stocks in 2023 and 2024, cut his Apple position by 60%, sold Bank of America shares, and he's not buying anything significant. He's waiting. For what? For the crash, for the opportunity to buy at fire sale prices, just like he did in 2008 and 2009 when he bought Goldman Sachs and Bank of America at depression prices with terms that guaranteed profit. Signal 3. Margin debt. Not quite at 8% of GDP yet, but approaching it. Currently around 7.9% based on latest data. And historically, when margin debt crosses 8% of GDP, crashes follow within months. 1929, it hit 8% in September. Crash came in October. 2000, it hit 8.5% in March. Crash started in April. 2007, it hit 7.8% in July. Crash started in October. We're right at the threshold, and margin debt is a mathematical trigger. When everyone's leveraged and prices fall, forced selling begins. It's not optional, it's automatic. Signal 4. Valuations. The Shiller P/E ratio, which measures stock prices relative to 10-year average earnings, is at 35. The historical average is 16. Anything above 30 has only occurred 3 times in history. 1929 peaked at 33, crashed. 2000 peaked at 44, crashed. Now at 35. The math is clear. When you're paying $35 for every $1 of earnings, you're pricing in decades of perfect growth. Any disappointment, any recession, any disruption, and valuations collapse. Signal 5. Economic data rolling over. GDP growth slowing. Quarter 3 2025 came in at 1.8% below expectations. Manufacturing PMI has been contracting for 3 consecutive months, below 50, which indicates contraction. Commercial real estate defaults are accelerating. Office buildings in major cities, empty because of remote work, can't refinance mortgages at current rates. Owners are walking away, handing keys to lenders. Regional banks that hold those mortgages are taking losses. Some are failing. We've seen 3 regional bank failures in 2025 so far. More are coming. The real economy is weakening while stock prices remain high. That divergence is the same as September 1929. Corporate earnings peaked in Q2 1929. They are showing signs of peaking now. Q3 2025 earnings were flat year over year. Q4 guidance is being cut. Revenue growth is slowing. Profit margins are compressing, but stock prices haven't adjusted yet. They're still priced for growth that isn't coming. Signal 6. Sentiment. Everyone believes stocks only go up, that crashes are impossible because the Fed will always bail out markets, that this time is different, that AI and technology justify any valuation. It's the exact same psychology as 1929, the exact same certainty, the exact same dismissal of risk. When you talk to people about the possibility of a crash, they look at you like you're crazy. They point to the fact that the market just hit all-time highs. They say the economy is strong, unemployment is low, everything is fine. It's the same thing people said in September 1929, 3 weeks before Black Tuesday. We're not approaching stage 5. We're in stage 5 right now, and if the pattern holds, and the pattern always holds, the crack comes in the next 30 to 60 days, November or December 2025. That starts the 18-month countdown to March 2027. You have 18 months from now until the 18-month mark of March 2027. Here's exactly what you do in 4 phases. Phase 1, November to December 2025, before the crack. This is your last window to de-risk. If you're heavily invested in stocks, reduce exposure now. I'm not saying go to zero, but if you're 80% or 90% stocks, get to 50% or less. Take profits, move to cash or short-term treasuries. Yes, you might miss a few percent of gains if markets keep rising into December, but you're protecting yourself from a 60% to 70% decline. The math overwhelmingly favors de-risking. Now, if you own speculative stocks, anything that's up 100% or more in the last 2 years, sell now. Tech stocks with no earnings, meme stocks, SPACs, anything trading on narrative rather than fundamentals. These will be the first to collapse and the hardest. In 1929, RCA fell 97%. The speculative stocks went to nearly zero. Consider buying protection. Put options on SPY or QQQ expiring in 6 to 12 months. Spend 2% to 3% of your portfolio on puts. If markets crash 50%, those puts will return 10 times to 20 times what you paid. If markets don't crash, you lose the premium. That's insurance. You buy it hoping you never need it, but if you need it, it saves you. Phase 2, December 2025 to January 2026. The crack and the false hope. When the first big decline comes, 10% to 15% in a week or two, don't buy the dip. Everyone will be saying it's a buying opportunity. It's not. It's month 1 of 18. Every financial network will have experts saying the fundamentals are strong. This is just a correction. Buy the dip. Ignore them. They said the same thing in October 1929. When the market stabilizes and rallies 10% to 15% in December or January, don't think you missed the bottom. That's the dead cat bounce. That's the false hope. Use that rally to sell anything you haven't sold yet. Get out during the bounce because the next leg down is coming. Phase 3, February to June 2026. The grind down. This is when you need psychological fortitude. Every month brings new lows. Every rally fails. The news gets worse. Your friends are losing jobs. Your neighbors are struggling. The temptation to do something, anything, will be overwhelming. Don't give in to the temptation to buy because stocks are cheap. They'll get cheaper. Don't give in to despair and sell everything in panic. If you de-risked in phase 1, you're in cash. Just wait. Do nothing. Let the market come to you. This is the hardest part. Sitting in cash, earning nothing while everything falls. But it's the right move, because phase 4 is coming. Phase 4, July 2026 to March 2027. The capitulation. This is when the real opportunity appears, when the market has fallen 60% to 70%, when unemployment is 12% to 15%, when everyone is terrified, when the news is apocalyptic, when your friends and family think you're insane for even considering buying stocks. That's when you deploy capital. Not all at once. Scale in over months. Start when the market is down 50%. Add more when it's down 60%. More at 70%. Buy quality companies with strong balance sheets, low debt, essential products. Companies that will survive and thrive long-term. Apple, Microsoft, Visa, Johnson & Johnson, Procter & Gamble. Names that won't go bankrupt. Names that will still be here in 10 years. And you buy them at 50% to 70% off peak prices. This is the transfer. This is when wealth moves from forced sellers to positioned buyers. If you have cash and courage, this is when you set yourself up for generational wealth. The people who bought in 1931 and 1932 at the bottom, they made fortunes over the next 20 years. Their children inherited that wealth. Their grandchildren are wealthy today because of decisions made in 1931. The people who bought in 2009 after the financial crisis, they made fortunes over the next decade. A simple S&P 500 index fund bought in March 2009 returned over 500% by 2019. The people who buy in 2026 and 2027 after this crash will make fortunes over the 2030s. But you have to survive to get there. You have to de-risk now. Preserve capital through the crash and have the courage to buy when everyone else is selling in terror. 18 months. That's how long it took from stage 5 to the 18-month mark where most of the wealth was destroyed. September 1929 to March 1931. And we're at the September 1929 moment right now. November 2025, which means March 2027 is the 18-month mark, the moment when the market will have fallen 60% to 70%. When most retail investors will have lost most of their wealth, when the transfer will be largely complete. This isn't prophecy. This is pattern recognition. The same signals, the same stage, the same mathematics. And mathematics doesn't care about optimism or hope or belief. It just executes. You can see this coming, or you can be blindsided by it. You can position yourself on the right side of the transfer or the wrong side. You can be the person with cash buying assets at 50% off, or the person forced to sell at 50% off. The choice is yours, but the clock is ticking. If this video helped you see what's coming, do me a favor. Hit that subscribe button right now, because over the next 18 months, I'll be tracking this pattern month by month, showing you where we are in the timeline, what to watch for, when to act. You don't want to miss those updates. They could be the difference between surviving this crash and being destroyed by it. Subscribe now. And if you want the deeper analysis, the specific stocks, the exact timing, the professional strategies, join as a channel member. The link is below. 18 months from now, the pattern says most of the damage will be done. The question is whether you'll have survived it or been destroyed by it. I'll see you on the other.